Good morning. It's Saturday morning. Driving. Nice and early. Nice sunrise we got here in upstate New York. But wanted to talk about the market. We had some nice implied volatility spikes throughout the week. I think it closed out on Friday around, the VIX was in the 20s, low 20s. So, and I think at its highest, it got in the mid 20s. I made some adjustments to the portfolio. I went back to SPX, I trimmed down my covered call ETFs. And my thought process there was I wanted to use that capital more efficiently. And what I mean by that is I was tying up about 10 grand in covered call ETFs that were maybe paying 8 to 12, maybe 8 to 14%. And I thought about it, with the SPX put spread, I can generate 2 to 4% a month. It just wasn't a good use of the capital. I still hold those ETFs, and I believe in those ETFs in the long run. So I have them in my other portfolio, but as in terms of my public portfolio, I want to squeeze the most I can out of this account. So this is more risky portfolio for me, for my personal tastes. Another adjustment I made is I used to sell 45 DTE 10-15 delta put spreads. They're real low in delta, and it generated an okay return. It was like 1 or 2%. Well, I moved to the weeklies to generate more theta per day. So right now I'm making about $35 to $40 a day in theta on a put spread. It's 60 points wide and it goes out 7 DTE. So my protocol for that is to start them off at 7 DTE. I'm gonna take profits as soon as it either beats the expected daily theta decay or I hit 50% profit. Time-wise, I'm looking at the 3-day mark. Once it hits 3 DTE, I'll go ahead and roll it, whether it's profitable or not. That's pretty much the protocol there. If it gets close to at the money, I would say within 5-10 points, I'll go ahead and roll it out. It'll be an easy roll because it's so low in duration that when I roll out to a further duration, it's going to be easy to collect more premium and lower my strike price, which increases my chances of getting profitability. The only thing I have to worry about with this strategy is a prolonged bear market, meaning the market's just getting beat day after day after day, going down and down. Then I'm gonna have to keep rolling, and that's when it gets a little dicey. But I've been through these situations before. I traded during 2022 when it was just 1 year-long bear market, and really that wasn't even a bad bear market, but in the greater historical context of things. As I wake up early this morning to drive to work, I got a weekend gig. I started thinking about how money has changed for me over the years. And when I was making $10 to $12 an hour, I was thinking, wow, if I can make 40, 50K a year, I'd be so ecstatic with that. Yeah, I can move out of my parents' basement, get a nice apartment, upgrade my car. I hit 50K and it didn't feel anything, didn't feel happy with that. Well, maybe I did. I was happy for like a week or two. But then I thought, looking at my pay stub, I'm like, man, if I could make like 80K, then I'd be good. I could rent a house instead of an apartment, and I could still, upgrade my car, and I'd be great. And then I hit 80K, and I'm like, wow, this is nice, but I want a vacation at least twice a year, and if I could just make 6 figures a year, back. Didn't even really, I mean, maybe it felt good for the first few weeks, but then it's like, man, I really want to put more money to investments and 120K, you know, you're using 60-70% of that to live, and then the other 30% you can invest. But it's like trying to fill a dump truck with a spoon. And I thought, man, if I could just make 150K, 160K, started making 160K this year, and it's like, man, now I'm going backwards. If I could just make 80K but not have to work, you know, that's the new goal. Make less money but not have to tie up my time. Like today I gotta drive across New York State, miss my son's last football game, just to keep bringing the money in. So I'm trading money for time for money. So the new goalpost is to just make money without all these obligations, time-intensive obligations. So just thought about that. And doing these long drives, I get to listen to like podcasts and stuff. So I was listening to a podcast with Joe Rogan and Chad Wright. Chad Wright, he's got a YouTube channel, and he talks a lot about faith-based stuff, which I enjoy. So he's talking about his journey of finding Jesus and being saved, and then he started talking about like challenges, like physical challenges, and that really hit me. I need to start challenging myself more and going to the gym more. There's no point in accumulating a bunch of money if you're not going to live long enough to enjoy it. So yeah, so back to the portfolio. Moving forward, I'm going to do SPX 7-day or 7 DTE, put spreads 60 points wide. I cut down my dividend ETFs to ULTY and BTCI, so I still have that Bitcoin exposure. Bitcoin got hammered. It seems to be following the greater market. I think most people think about it as a way to diversify, thinking it's going to be like gold, where it'll appreciate while the market's going down. But it seems, at least from what I've seen, it seems to be following the market more, or having a heavier correlation to the market instead of an inverse relationship like gold has been ripping higher as the markets go down. So in addition to the dividend ETFs, I still am doing the wheel trade. I adjusted that slightly too. I wanted to limit my exposure, kind of let off the gas pedal. I don't want to put a bunch of cash secured puts out, then get assigned on hundreds of shares, and it's just so much harder to dollar cost average when you allocate a large portion of your portfolio to buying shares. Whereas on the inverse of that, if I just sell one cash secured put at a time and I get assigned those shares, it's so much easier because I only have 100 shares. If I have enough money to buy 500 shares, that means I could get assigned the first time. So say I'm looking at a stock that's $100 a share, and I'm selling the 100 strike. I get assigned 100 shares. Now I've allocated $10,000 for that 100 shares. And say I have a $50,000 portfolio. That stock goes down 5%. Or let's say that stock goes down 10%. Now it's trading at $90 a share, and I sell the 90 strike. I get assigned on that. Now my dollar cost average is 95 for 200 shares. Selling the 95 covered call, you're going to collect more premium. It's going to be more worth your while than trying to sell that 100 strike covered call when it's trading at 90, because you're further out of the money on the cover call. That's why I like to keep a lot of dry powder when it comes to the bill trade. In order to compensate for that, I sell shorter termed options because I collect more theta per day, more premium per day. And that's the name of the game, is keeping that number high. That's what I track. That's my metric that I most look at. Is how much premium theoretically earning per day. And it's a very simple equation. It's just how much you collected and how many days to expiration. So you collect $100 and it expires in 10 days. That's expected $10 of data per day. And I track that at the portfolio level. So my goal for the portfolio, which is 60K, is to collect $40 a day. $40 a day times 30 days a month is $1,200. $1,200 on a 60K portfolio is 2%. So the goal is 2% a month, 24% a year, cash flow. I'm going to be putting that money to work. I took out $3,000 because I made $3,000 cash on cash. So I went ahead and withdrawed that from the account. So I'm keeping my cost basis pretty much 60K. Well, actually, technically my cost basis is now 57K because I took 3K out in profit. But my net liquid is still around the 60K mark. So I'm gonna put the capital to work. I don't know. I'm thinking about a lot of different things. Maybe buying a car, or maybe get some equipment, some filming equipment. Invest a little bit more in the YouTube channel, or maybe ads or something. Website. I don't know. I'm still thinking. I'm chewing on it. So, but yeah, take care and God bless.